Hello, everybody. You're very, very welcome today. And today I'm so excited. I'm joined by George Skelton. George is the tax partner of RDA Accountants, and all things tax goes through George. So, George, hello. It's lovely to have you here today.
Thanks, Paul.
And I suppose today we're here to talk about, and we're going to be doing a lot more of these live tax talks, tax smart as we call it ourselves. But today we're talking about, there's a question that came that you said one in four entrepreneurs are missing out on massive tax savings when they sell their business. And I suppose that massive tax savings is entrepreneurial relief. And big question, are you one of those people that are missing out on entrepreneurial relief? So can you just tell us a little bit about it and what entrepreneurial relief is?
So, in its most basic sense, when a business owner sells shares in a company they own or sell business assets, capital gains tax applies to that sale. And without any relief, you would pay 33% on any gain made. What revised entrepreneurial relief allows you to do is to pay 10% on the first 1 million of any gain. So, to put that in perspective, if someone wants to sell their business for €1 million, make a gain of €1 million, without revised entrepreneurial relief, they'd pay 330,000 in tax. And with that relief, they pay 100,000 in tax. So potentially 230,000 in saving by being able to claim entrepreneur's relief.
Why is this often overlooked, or what's the reasoning behind this?
I guess it's just a lack of awareness. Essentially, you're just ensuring that you're in a position to claim that relief when the time comes, when you've sold your business or sold your shares in your family company. Like, it's a relief, it's there, it's available to everyone. I mean, a lot of people will be aware of retirement relief, but to qualify for retirement relief, you have to be age 55 or over. Whereas revised entrepreneur relief is there and available for anybody who meets the conditions to qualify for that relief. There's no age limit. The real kind of the main condition, if you like, is that you've owned those shares in a qualifying company for more than 3 years. Once that condition is met, you should be in a position to qualify for the relief.
Irrespective of what age you are.
Yeah, like I said, you have to have been a company director or an employee of the company for 3 years and worked in a managerial or technical capacity for more than 50% of your time in that company. So if we're talking explicitly about the sale of shares in a company, which, look, the majority of the time that's where we see the relief being claimed. Like I said, it's a 3 year ownership test, and it's a 3 year test that you've worked in that company in a managerial or technical capacity for more than 50% of your
And
time.
it is potentially one of the biggest tax reliefs that are out there in the market for a small, medium sized business.
Yeah, I mean, for a lot of people, for everybody that's under age 55, it's really the only relief that's there for the sale of the shares in your business. Like, it's also potentially, like, if planned correctly, we would have clients who were in a position to claim revised entrepreneur relief before their 55th birthday, and then retirement relief on the subsequent sale of other assets after their 55th birthday. So, like, one relief doesn't necessarily preclude you from the other as long as you time the sale of your assets correctly. If you're over 55, it's not as straightforward, because if the sale qualifies for both reliefs, you just pick the one that's beneficial to you, most beneficial to you, but you may also have used up the other relief in that. So it's just something that requires a bit of planning. Like I said, the relief is there. I won't say it's easy to qualify for, but it's possible to plan so that you make sure that you qualify for it. Like, some of the mistakes I've seen people make over the years is, say, a group, someone might have a group of companies where they have 3 or 4 companies as part of the one group, and one of those companies is dormant. If you have a dormant company within a group, you cannot qualify for revised entrepreneur relief, but it can be as simple as removing that company from the group. So with a little bit of planning and a little bit of thinking and a bit of foresight, you can make sure that you're in a position to qualify for that relief when the time comes to sell your business or to transfer your business to the next generation, whatever your intention might be. But it's important that you do that little bit of planning to make sure that the relief is there and available to you.
So I suppose there's four critical steps then in entrepreneurial relief, and the first one I suppose is the 5% shareholding.
Yeah. So to qualify for the relief, you have to own at least 5% of the shares in the company if you're disposing of shares in the company. So, like, for the majority of people, family companies, that condition is likely to be met. I suppose where you might have a situation where it wouldn't be as if there was a number of children or a number of family members involved, and maybe someone had given them a small shareholding just to get started. If there's a situation where you think the company might be sold in a few years' time, it makes sense now to make sure that that 5% shareholding condition is met, if at all possible. But yeah, you have to have more than 5% of the shares of the company. And like I said, you have to have worked in the company in a managerial technical capacity. So that's clear in the legislation. So, for instance, a company director, I suppose, is naturally is working in a managerial capacity. If you're not a company director, it's just to make sure what is your role within the company. And will that role allow you to qualify for the relief?
So that's the active involvement role, is it? You have to be active.
Yeah, essentially, yeah. But it's active involvement in a managerial or technical capacity. So, that you're involved in the day-to-day running of the company to some extent. If you had a situation where, let's say, there's a son or daughter working in a shop and they might own 10% of the company, but if their role in the shop is just checkout, or, it's not in a managerial or technical capacity, then they may not qualify for the relief. So it's just, again, it's something that can be planned for if needs be.
And then the others, it must be a trading company.
Yeah. So if the company, for instance, is a property rental company, that will not qualify for relief. If it holds not development land, that won't qualify for relief. It can't be a company that just holds investments. It has to be a qualifying business. And for the most part, a qualifying business is almost any trade business, So if you have a company and all it does is hold rent property, you won't qualify for this relief. But in the majority of cases, if you're running a family business, the relief should be there available to you, provided all the other conditions are met.
So if I had a group structure and I had a property in it that was getting rental income on it, and I had another one where I was doing investments and that, then I had my trading business, there's some planning needs to be done to qualify for entrepreneurial relief.
Yeah, how it works within a group of companies. A group is looked at for the relief as a holding company and all its 51% subsidiaries. If any of those 51% subsidiaries aren't carrying out a qualifying business, then none of it qualifies for the relief. So it's just a key point, like you said, to do some planning around that if needs be, or to be aware of that. That you don't assume that you will qualify for the relief when it may not be there.
So the things to kind of watch out for is making sure that if holding company structure is set up properly to allow you to avail of the relief.
Yeah, exactly. And look, for instance, a lot of people would set up dormant companies because they'd have an intention to maybe move into a different business stream or separate a new business. And for whatever reason, that might never happen. And a lot of people just let the dormant company sit there. We might use it someday is basically the attitude. But having that dormant company there at the time of sale might preclude you from the relief. So it's just a very easy fix. Like I said, that's where the planning is important. That's where it's important to sit down with your advisor, go through your own situation, go through your own circumstance, and make sure that the relief is there available to you. I suppose on a quick chat like this, the main thing is just to make people aware that the relief is there. The actual conditions and stuff is something you need to work through with your advisor when the time comes. But anything is better when it can be planned for. You know, we talk about there's a kind of 3 year run in with this relief, which again kind of is an advantage it has over retirement relief, because with retirement relief you have to own the asset for 10 years, and in the case of a company you have to be a full time working director in a company for 5 of those 10 years. So that's not necessarily the case with entrepreneurial relief. So it gives you a little bit more flexibility.
So if you had a company set up a brand new business and you were able to avail of the relief where you don't have to pay corporation tax for a couple of years, up to a certain limits, and after a 4 year period, you then took that relief and sold your business under entrepreneurial relief, you would end up physically paying very, very little if your business was worth under
Yeah,
a million.
the two reliefs are unrelated. So, like, I mean, there is an exemption for startup companies, and if certain conditions are made, the company can claim an exemption for corporation tax up to 40,000. But that's completely separate from revised entrepreneurial relief. Revised entrepreneurial relief applies to the sale of the shares in that company by the shareholders.
But the 40% you're talking about is 40% on tax. It's not 40% on profit, is it?
For the startup company exemption, it's up to 40,000 of tax can be exempted. So, like, that's quite a lot when our tax rate's only 12.5%.
It's huge.
Yeah, yeah. But like for a revised entrepreneur relief, it's 10% on the first million of any gain made by the shareholder. Just a key point to make here: revised entrepreneur relief only applies to individuals, so it's only available to individual shareholders as opposed to corporate shareholders.
Oh, yeah, that is a big thing.
Yeah, yeah. So, like I said, it's a very important relief. It's there. It allows entrepreneurs to benefit ultimately from the sale of their businesses, especially entrepreneurs who are under 55. And prior to the introduction of the relief, I think in 2016, there wasn't an equivalent relief here in Ireland. There had been entrepreneur relief had been in the UK, and essentially we have taken that relief, and it's now available in Ireland to anybody who's in a position to claim it.
And what other things in the company then, if you're looking at kind of a trading company, do you need to get tidied up in terms of the entrepreneurial relief? Like, are you looking to make sure, it's all around employment and it's all around common sense, and it's around understanding your roles and
The relief applies to qualifying businesses, so you just need to make sure that your company is actually operating a qualifying business. What could happen in a situation like that is like we would have clients who over the years have used excess cash in their companies to build up a property portfolio, for instance. And if it got to a situation where the property portfolio side of your business was actually larger than the trade itself, well, then the company is no longer a qualifying trading company. Every situation, every circumstance is a little bit different. You need to tailor your own circumstances and ensure that you qualify for the relief in those circumstances. But the key points are is that your qualifying trading business, like you would actually suggest as well, Paul, that you own more than 5% of the shares and you've owned those 5% for more than 3 years. That's their starting point. After that, then you can kind of look at all the remaining conditions and just ensure that you qualify. But the starting point is that you've, in case of a company, that you've held those shares for at least 3 years and you own more than 5% of the shares in the company.
so the big message from me here on this one is one, it's a relief that's available to companies in Ireland, right?
Yeah,
There's four critical entrepreneurial tests that you need to have, which is the 5% shareholding, the active involvement, it's a trading company, and the last one is the asset disposal. So it's qualifying business assets and it's typically shares in a trading company. If you're not in a company, are you entitled to this relief as well?
yeah. Like as long as you're disposing of a business asset. So in the case of a shareholder, that would be,
The shares in the business, and in case
yeah, exactly. I used the example of a shop earlier. If you own a family shop and you operate as a sole trader, you can still qualify for this relief if the shop is sold. It doesn't have to be shares in a family company. Now,
but if you're somebody like a doctor,
yeah, potentially that relief should be there. Like as long as you're operating a qualifying business and like a doctor would be, yeah. So if there's goodwill in the practice, there's no reason why this relief wouldn't be available to you on the sale of the goodwill in that practice.
yeah, so like they're the biggest things, and what I'm learning from this is again, it's the simple thing, it's the planning.
Yeah, exactly.
You know,
Yeah.
always about planning in time and understanding, the life cycle of your business, understanding whether you're at startup, grow, scale, or harvest, and there's no time too early to look at structures in a business. That's the biggest thing that we're seeing here, and conversations you're having with people is a lot of the times, this being tax smart means that, you're having these conversations, but it's not a once and done. It has to be
Absolutely.
updated.
Oh, absolutely. Look, rules change, circumstances change, family circumstances change. I think it's always important for clients to have, like you said, to have that plan in place and to review that plan kind of periodically, whether that's every 6 months, every year, whatever it might be to suit their circumstances. Because the plan can change. Relationships change, tax laws change, anything. That we're just ready. But once you have a plan in place, you can tailor the plan as those circumstances change when you move forward. Like I suppose today we're focused on revised entrepreneurial relief. There's a whole kind of suite of reliefs around that plan that may or may not be available to people in terms of how they build up cash in their company, how they look to utilize these reliefs moving forward. We've talked about entrepreneur relief, and we've spoken kind of in the terms of a sale or in terms of a succession plan, but it also applies to a liquidation of a company. So if you have a family company that's no longer required, potentially revised entrepreneur relief could be available on the liquidation of that company as well, if certain other conditions are met at that time. So it's a very important relief. It's a very useful relief. Certainly, we've had a number of clients who've been able to benefit from it over the years. And like you said, you're talking about potentially up to 230,000 of tax saving. That's almost a quarter of a million. It's an awful lot of money, and it's
People don't have that in their pension fund, some
yeah,
people.
yeah, yeah. It's really important relief and really important that people are aware of its existence.
And what are the things that, in terms of a case study or in terms of something, what are the things that you've seen in the past that, people thought they were automatically entitled to this? Now, I suppose it's the obvious ones where they had investments or something in it.
Yeah, I mean that is the main one. Investments in the company or dormant companies within a group or property rental companies within a group or family members owning less than 5% of the shares. Exactly all those things we've seen over the years where people have been unable to qualify for the relief. Like we have a business sale very recently where the husband owned 99% of the shares, the wife owned 1%, and because of that, the relief wasn't available for her in that instance. It was only a small shareholder, and it wasn't a massive tax
But
cost,
the
but
planning cost of that was thousands.
yeah, yeah. Like I mean, it's one of those things where with a bit of foresight, that could have ensured that the relief was available to both both people.
So it's the connected advice scenario that we're talking about. One plan, one team. It's really all about that connected advice
Yeah, absolutely.
and talking regularly. So people, they can find you on LinkedIn.
Yeah.
In terms of locating you, you're all over the website, and this is something that we are kind of going to continue to do in terms of the Tax Smart Talks. George will be bringing out a newsletter as well. So if you're looking for to get access to any of that information, just drop us a line.
Yeah.
And have you anything else to say, George?
Be delighted to talk to anyone who wants to discuss Revised Entrepreneurial Relief in a bit more detail.
Okay, so thank you so much, and we shall talk again soon.